12. Welcome to your crash course in accounting for paper 1. My name is Millie van Eysen. I'm a teacher at Brackenfell High School, and I'm going to take you through a few last pointers that is important and that you might need to know before you're going to write your paper. So I hope you've got a pen and a pencil and a calculator and a piece of paper ready. So let's get to it. When we're going to study for paper 1, it is very important to know what is in paper 1, what content will be covered. So the paper consists out of 150 marks and the time for that is 2 hours. You will see over here, we've got the income statement as well as stock questions. We've got the balance sheet with the notes, and then again, there can be stock questions in there, cash flow statement, and then depreciation. And then the paper ends off with analysis and interpretation and our corporate governance and ethics and internal control. So please remember that this is just a guide. The marking allocation is also just a guide to help you. It's an estimate of what you will find. And then obviously in your income statement and balance sheet, you will also have your adjustments. I've decided let's just do that. If you look at income statement, balance sheet, and cash flow statement, that consists of 70% of your paper, more or less. And your analysis and interpretation, corporate governance, ethics, and internal control is 30%. So also, general theory, including audit reports, will be found in the last bit of the theory, and that will be part of paper 1. So we are going to look at financial indicators today. That's the 30% of the paper. So this is just a strategy to help you when you're going to start studying. I would really advise you to write down the names of all the ratios and financial indicators on your formula sheet when you study the formulas. The formula sheet really means nothing if you do not know the names of the formulas and to which formula it actually belongs. These formula sheets are available as part of the paper on the internet, so you can actually just Google and download a past paper and print out a formula sheet for yourself. Then also, this part I've highlighted and made it bold. Dividend payout policy. This is something that you will not find in any textbook. But guess what? It's in the final paper. So it is really important that we actually go and look at the dividend payout policy, how we calculate it. I showed you over there. It's the dividends per share divided by the earnings per share times 100. And that's then expressed as a percentage. And normally in a question, we'll compare 2 years with each other, or we'll compare 2 companies with each other. If the percentage is small, low, then it means the company is actually keeping funds back to expand in future. So they are not paying out money towards their shareholders. If the percentage is big and high, then it means the company actually wants to keep their shareholders happy and they are paying out as much of their funds possible to the shareholders. So that is something that you need to write down because, as I said, it's not in a textbook. Right, so we are going to jump into it straight away. Here I have 4 typical questions. I call them loaded questions. And it looks at the 4 main types of commenting on financial indicators that you need to be able to do. So before we get to these 4 questions, you will have to be able to work out a financial indicator by using the formula sheet. So that is something where you just look at the figures and you put them in the formula and calculate an answer. Something easy to study. This is then where we all get stuck. What are we going to write in our comment? And I'm going to show you for all 4 of them, they have a specific way of commenting. So whenever you see the word liquidity, you're going to comment in a specific way. So we're going to look at liquidity today. We are going to look at when there's a loan involved. We are going to look at the dividend payout policy. And then we're also going to look at the price of shares. And with these four, whenever you see those words that are pointed out now, you will know there's a specific comment that you just adapt around the figures, but the words will stay the same. So this is more or less what you will get. They'll give you a table with financial indicators. They will also give you part of an income statement, and they might also sometimes give you part of a balance sheet, because obviously you first need to work out some of the indicators. You will see there the three that I actually highlighted in yellow was in the paper where you actually first needed to work them out. But as I said, I would rather like to focus on the commenting. So we are going to look at those three when we are going to comment on liquidity. And just going back to the previous slide, the reason why we're going to look at them is the question says that the company's liquidity improved, and we need to quote three financial indicators to support this. So they are looking at indicators that improved. Okay, so that's why I only look at those three. Stock turnover rate is also part of liquidity, and the stock holding period as well. But I can only look at those three out of the four because they are the ones that improved. So what will my typical answer be? Focusing on that it improved. And I'm really emphasizing that because if you did write about the stock turnover rate in your answer, and it was here in between current and asset test ratio, I only mark the first three. The markers at the end of the year only mark the first three. So you have to make sure that you pick the correct three. I like using the words improved instead of saying that it increased, because improved tells me that it increased and that it's good. Where if you're going to tell me that the current ratio increased, then you have to give me another sentence to tell me that it's actually good. So I said the current ratio improved, the asset test ratio improved, and the debtors collection period improved, meaning debtors are paying their debt faster. Okay. You can always then end off with a general sentence saying that the business will be able to cover all short-term liabilities, because that is what we see from the three ratios. If the asset test worsened, it means that they are relying too much on stock. So too much of their funds are tied up in stock. And it's very important to understand this, because they sometimes ask you to just comment on the first two, and instead of the asset test ratio improved, it actually worsened. And the reason why this is so interesting is if the asset test ratio worsened, it means the bulk of their funds are not physical money, but actual stock in their shop. And what happens during a lockdown, like we had in 2020, all shops had to close down. All the money that they could have used was in the shop in the form of stock. And that's not good. We would like a healthy balance between stock, money in the bank, and debtors. That is why this cannot go in the negative direction. Right, so that's liquidity. Back to our table. Now we're going to focus on the ratio that looks at the loan. So if you were to actually pause the video and go back and look at the question says that the directors decided to take out a new loan, and we must now comment whether it was a good idea or not. We must comment on the loan. That's the bottom line. We are going to look at debt equity for this and return on total capital employed. Normally, your questions will also say, please quote two figures. But here's the issue. There's a third one that you need to comment. You need to put the interest rate on the loan in your question, in your answer as well. So let's look at a typical answer. You will see the debt equity ratio, the debt part actually got higher. Why? They took out a loan. Return on total capital employed improved. This ratio tells us how efficiently are we using our money? How fast am I making more money with my money? And the interest rate on the loan tells me how fast must I pay back money? So we would like this ratio, return on total capital employed, to be higher than the interest rate. I want to make money faster than the rate that I'm actually paying back. Right, so the directors decided to increase the loan. Is this a good decision? So here's my typical answer. I need to comment on the return on total capital employed. I'm saying that it improved and that the company are therefore using their funds more efficiently. I also then say that it's positively geared because that ratio is higher than the interest rate on the loan. And then I end off saying that the debt equity improved. Yes, it's not always good to have debt, but I can go up all the way to 1 to 1. So we are now at 0.32 to 1, which is still a very small part of it is a loan. So the company did take out an additional loan. That is why it improved, but the risk is still low. They are not making use of loans. They rely more on their own funds. So they can actually, there's room to take out another loan. The difference between the interest rate and Roche is very big, and they've got enough space over here. So this is a healthy company with healthy debt, and they are well managed. Going back to our table, now we are busy with question 3. The third question, if you remember, was about the dividend payout policy. We had to comment on the dividend payout policy, and we are going to use the dividends per share and the earnings per share. That's the only two things we look at. But we need to look at both years. And then, very importantly, the question did say that the shareholders are not satisfied. So we need to include that in our comment and maybe say why. So let's go and look. For 2017, I took the dividends per share divided by the earnings per share. For 2018, I did the same thing. Let's quickly go back. Dividends per share is 60 cents. Earnings per share is 75. Dividends per share is 21 cents. Earnings per share is 61. So I'm basically just dividing it and then multiplying with 100. So in the previous year, the shareholders received 80% of the earnings. So the company paid out majority of the funds to the shareholders. This year, or the next year in 2018, the shareholders received only 34% of the earnings. So it means the company is holding back money. Now, it's a good thing and a bad thing. Bad because the shareholders would really like some earnings, and good because the company might want to expand, which means in 2 years' time, the shareholders' earnings might double or triple. So our explanation for why they should be unsatisfied is that the company decided to retain a large percentage of the earnings, larger than the previous year, for expansion in the business. The directors may have explained their strategy in the annual reports, and they should. They normally do. If it's such a big drop, then they will explain why they've decided not to pay out money to the shareholders. But now again, we just came out of heavy lockdown last year in 2020. All companies, all businesses froze, and they decided to go about their business very, very cautiously. So if the previous year was 2019 and the current year 2020, and this drop happened, we cannot give the explanation that I just showed you. We will have to say, due to the COVID pandemic, company and lockdown, companies had to decrease the funds that they paid out to the shareholders in order to survive. So it's very important. It wasn't in the past, but now it's extremely important to look at the year of the financial statements. Right, so there it is. If this was from 2019 to 2020, the company might have retained funds due to lockdown and COVID. So please keep that in mind. Okay, last one. So now, if you remember, we are going to look at share prices. So share prices is also a tricky one because there's a lot of different things that you need to include in your answer when you comment. So let's look. Commenting on a price. You need to look at the net asset value. You need to look at the market price only of the current year, which is 2018 in this case. And then we look at the price paid in the question. This can now be for shares bought back or for new shares issued. They can swing it either way. You then just use the price in the question. So we've got 418 cents as the net asset value and 380 cents as the market price. So the 380, which is the market price, that's the JSE price. They look externally at the company and they view the company. They look at the image and the financial statements and some other social factors as well. And that will decide what the market price will be. The net asset value, which is 418 cents, only focuses on the financial statements, the values in the financial statements. And these two are normally, and we hope to have them close together. So the price that the company paid over here at the bottom is 430 cents for the shares. The net asset value was 420. The market price went from 400 down to 380. So the market price is basically your realistic price. That's normally what you'd like to pay for the shares. They paid 50 cents more for the shares. So that's not a good option. In the company's view, they are really valuing their shares. That's why they are paying so high. But in business, we want to save wherever possible. So if the goal is to save and minimize your expenses, you are not going to pay 50 cents more when you actually only have to pay 380. So when you comment on a price of a share, it is important to remember there's three prices that you need to quote in your comment: net asset value, market price, and then the price paid. Okay. I hope everybody's still concentrating. So now we are going to look at corporate governance and ethics. So this again fits in with the bottom 30% of the paper, and it's a bit of theory. From my experience, it's easy theory, but we don't always study it, and sometimes we don't always understand exactly what to write. This theory is in all the questions. So I thought, let's go through this, and hopefully when you write your paper 1, you've got 15 marks in the bag. So what do you need to study? You need to study all your notes on corporate governance. So that's ethics, it's the King Code, all of that. Ethics is integrated into all questions. So our favorite answer, your favorite answer when they talk about ethics should be division of duties. But if you give me those 3 words, then you will only get 1 mark. You have to write more to earn the 2nd mark. What do I mean about writing more? You have to explain to me that I'm going to divide a duty, which means if I've got someone that's ordering stock, then one person will order the stock and the other person will release the payment for the stock. And then you can even have a 3rd person that will receive the stock when it's delivered. So you've got 3 people checking up on each other. If it's only one, he can order stock for the company and for himself. He's going to pay for it. He's receiving it. He just puts it in his car and takes it home. Nobody will check up. And then we are also going to focus on audit reports. There are 3 types of audit reports. There's a qualified report, unqualified, and a disclaimer. And they always want you to identify the type of report given by the auditors. So I've given you the explanation over here for all of them. A qualified report is a small issue in the statements. It's not hectic. So they are basically just highlighting something that might be a question mark, a small issue. Unqualified report means that the financial statements are correct. They represent a true reflection of the company. The auditors find nothing wrong. Then we get a disclaimer. A disclaimer is when the auditors refuse to give an opinion on the financial statements because there's too much that's wrong. They don't want to put their name next to the company saying that they've audited the financial statements. So this is basically how a short version of it looks. And it's really between, this is now a 6-mark question, it's between 6 to 15 marks. So we are going to look at a specific audit report, but they first ask us to whom it is addressed. And an audit report is always addressed to the shareholders. Why? The shareholders are the owners of the company. So the auditors are basically telling the shareholders that everybody in the company did their job properly. Who must ensure that the statements are prepared and presented at the annual general meeting? That's the job of the directors. Shareholders don't normally work physically at the company day to day. That's the directors. That's a qualified person that actually applied. They've got a degree. They've got experience. They will run the company and make all the big decisions. Then they like to ask as well, why will the auditor refer to a set of pages? In this case, they said, please refer to pages 11 and to 29, and then they will give their comment. The reason is that this is the specific pages where you will find the financial statements, and that's the only responsibility that the auditor has, to check up on the financial statements. And now the last question, we need to check what type of audit report it is. They give us the options again. So for that, I've given you over here the extract that they'll present in your question. So it says that after they've looked at the pages, in our opinion, the yearly financial statements present fairly in all material respects the financial position of the company, and that it is in accordance with the international reporting standards as well as the Companies Act in South Africa. So this shows me that it's an unqualified report. They didn't highlight anything that's wrong. How will an unqualified report look? There will be a third bullet in this paragraph stating that in all material respects, everything is fair apart from advertising expense that's without valid proof of documentation. So they highlighted one little thing that they are not happy with, then it's a qualified report. The disclaimer you will be able to identify easily because they will just say, we cannot give a comment on the financial, express an opinion on the financial statements. Then you know it is a disclaimer. Then I thought, let's put in some weird questions. Nowadays, the people setting your paper is extremely creative. They try to come up with the weirdest questions ever. It's really the weirdest questions for me in history. So the first question will be, provide an example of evidence that the auditor will need to look at when conducting their audit. And it's a simple answer, but we are now in grade 12. We think everything is higher order, and it's actually so simple. What evidence should they look at? They should look at source documents. The invoices, the receipts, the EFTs, any other references. So all companies actually need to keep a copy of all source documents linked to every single transaction. Next question. Why are the auditors referring to the Companies Act in their report? They said that the report, the financial statements, is in line with the Companies Act. Why is it important to mention that? Because the company is adhering to the legislation in terms of the publication of the statements. And that's good to know because it boosts their image as a company. Then, thirdly, describe the role of the audit committee. And that might be something that you haven't heard about this year because we might not be focusing on that so hectically. It's more always adjustments and statements. So what about an audit committee? What do they do? The audit committee is made up of people inside the company, so it's employees of the company. They need to nominate the external auditor. They need to ensure that that appointment of the auditor adheres to all legislation and that it's then given at or presented at the annual general meeting. Right. Then grade 12, I'll leave you at that. I really hope that this benefited you. Good luck in preparing for paper 1. Knock them out with your genius.